Welcome to the Alternatives Mason podcast. With host Brittany Mason, Chief of Staff at Banrion Capital Management, you'll learn how to build alternatives knowledge brick by brick. Banrion Capital Management uses technology to help independent advisors scale and educate themselves on alternative investments. And since education is such a big piece of what we do, we are excited to kick off the series to dive into the nits and grits of the alternative space.
Hi, everyone. It is Brittany Mason coming to you live from the green couch with another episode of the Alternative Mason. I'm really excited today because we have a special guest, the CEO and co-founder of Pender Capital. We have Cory Johnson here with us today. He is bringing over 20 years of expertise in real estate acquisition, development, finance, and asset management. And since co-founding Pender Capital in 2015, he has driven the firm's success in the U.S. real estate credit opportunities market with a focus on funding loans exceeding $1.4 billion. So Johnson's background includes founding real estate funds and overseeing distressed property management, delivering strong returns for his investors. So thank you, Cory. So excited to have you on here today.
Thank you, Brittany. Pleasure to be here.
Yeah. Well, I want to, you're in California, correct?
Yeah, I'm sitting right now in one of our offices in Los Angeles, California.
Okay, and you guys are nationwide. So where all do you have offices?
Yeah, so our headquarters these days is in Dallas. It used to be one of our big origination platform offices, and my partner, our CIO, Zach Murphy, moved there during COVID. So we decided to kind of move the headquarters along with him. And we do have a couple satellite offices, one in Chicago and one opening up near Charlotte.
Fantastic. Well, so have you always called California your home?
California has always been my home. Yeah, it's I'm one of the rare Angelinos that both my parents are actually born and bred in Los Angeles as well. So kind of like the new age West Coast implant.
So you're never leaving, huh?
You know, it's funny. California, for everything that is challenging, I think the state right now, it's still a beautiful place to call home. I mean, it's kind of hard to beat on many levels, but I think it's going to take a lot to get me out of here, to be honest.
I agree. I used to live I was in Santa Monica for a bit, and then I was in West Hollywood, and no, there's nothing like the California weather and being able to go to the beach. And it's
you know, Brittany, even though the last 2 years I saw it on actually a Dodgers podcast or broadcast the other day that LA has got more rain days than Seattle this year.
It is so bizarre. The weather, I feel like, though, everywhere has been just bizarre. I mean, I spend a lot of time in Las Vegas, and even the weather out there has just been, the winds, and then it didn't even break 100 degrees last year until I think June, which is bizarre for Vegas. And but I feel like the weather everywhere. So yeah, I don't know.
Very bizarre this year.
Yeah, well, I'm really curious to know, growing up in California and your household, I'm really curious to know the foundation of your relationship to money. What's your first memory that you have associated to money?
Well, it's interesting. So I grew up in, kind of a very entrepreneurial household. My dad was an aerospace engineer, had a business that's, put a lot of hydraulics on a lot of the old Boeing 7 Series jets and whatnot. So, my earliest memories are really listening to him, kind of the trials and tribulations of owning your own business, right? And, when I kind of got older and kind of came into the, out of school and started getting my jobs, it was really funny. My dad gave me the advice. He goes, yeah, don't go after something where you can make the most money coming out of school. Go after something that you can, get the most experience, because long run, that's going to help you out. And of course I did the exact opposite, right? I went for something that I was trying to make more money earlier on. And, it was an interesting, I started my career with Weyerhaeuser Mortgage Corporation, which was better known as WMC, which really was kind of focused on a lot of subprime real estate debt, kind of, pre-financial crisis. And although it was a very challenging job in the sense that, you felt like you kind of needed to spray yourself off with a fire hose at the end of the day. I learned a ton, and it kind of, charted the course of my career of, kind of understanding, starting off on the debt side, kind of, and then I moved to the, equity side and acquisition side of the table. So I got this like well-versed, candidly, I probably have a very non-traditional path to where I'm at today and what I'm doing today. But, it's nice to be able to kind of draw back on some of those experiences early on and kind of understanding like, this is where I ultimately see myself going down in the future.
Yeah. And what would you say was the greatest lesson then on that path? Would you say was there, a pivotal moment where you're like, okay, an aha moment where you're like, okay, I'm actually on the wrong path. This is more of what I'm interested in and what I should be doing.
It's funny. I don't know if there was the ultimate like just aha. I knew I wanted to eventually kind of start something myself. And I think that was just kind of instilled in me through my father and growing up. So I remember right before the financial crisis, I had moved up to the San Francisco Bay Area. I was working for a company called Richmond American Homes. We were the 9th largest home builder in the nation at that time. I was doing acquisitions for them. And it really kind of, crisis hit, hey, we're not going to acquire land for years to come. So that was my aha moment of, like, hey, I think if there's a time, this is it. I've got to figure out something to do. So basically, went out and kind of, begged, borrowed, scrapped, and still tried to raise some money. We started a couple of opportunistic funds that actually went back and started buying distressed public home builder assets at that time. That kind of morphed back over into the debt side of the table. I was talking with, a pretty close family friend that was pretty well-to-do. And, at that period of time, even a guy that, had a, 800 plus credit score, he was looking at for a 20%, rate and term refinance on an income property that he had down in coastal Orange County. And he called me because he knew I was kind of tangentially in the business. And he goes, Cory, I can pay cash for this asset 10 times over, but no bank will lend to me right now because I'm not a W-2 employee and my tax return shows some losses for a few years. And so it was kind of a weird like light bulb moment kind of flashing in my head. I'm like, wait a minute, if this guy's having problems obtaining financing, there's got to be a ton of other people that are having similar issues. So that was kind of like, I say probably, iteration number 4 of my business career. At that point, really started kind of arranging debt for, companies or individuals that were looking to obtain, financing that the banks just couldn't provide during that period of time. So that was kind of, pre-Pender Capital, but kind of leading up into kind of, what we do today and, what we provide. And, today the market's not, it's more similar to kind of how it was post-financial crisis. So it's kind of a strange kind of full circle of my career of kind of where I've gone and kind of where I ultimately sit today.
Yeah. I just when you said your dad was in aerospace, I just wanted to say I love airplanes. I've always been so fascinated with airplanes and flight in general. And so my question was actually one of my questions I was going to ask, why didn't you go into aviation and some sort of aerospace sort of career? Why did you choose real estate? I mean, but it sounds like you just found the opportunity and you couldn't resist,
Brittany, it was really funny. My parents, they really were into, non-nepotism. They really saw I think the accomplishment of starting something themselves, and receiving that, from infancy up until, where it ultimately became. And so when we were growing up, one of my brothers and I were kind of similar in age, and I got one that's a bit younger, but they used to throw us, into basically the big machine shop, right? Not the front office jobs, but the stuff. It was kind of back, kind of, really more kind of dealing with the parts, dealing with everything else. So it was one of those that I think it was almost a plan, say, well, these guys are not going to want to do this type of business when they grow up, and because I think they want to just allow us to kind of spread our wings and kind of figure out something on our own and work it from that straightforward. It was so interesting though growing up, and seeing, I would get on a plane. My dad could point any plane out in the sky, tell you exactly what it was, if they had parts on it. But it was just fascinating. I remember being on, a Southwest flight when I was a kid, and, the flaps went up, and he's like, "Oh, do you recognize that part?" And I'm like, "I do." And the fact that it came out of your shop is frightening to me, because I see some of the guys in the back and they're crazy. But I mean, it was such an interesting kind of childhood. Anytime there was any aviation, disaster, my dad was, freaking out, because, if their parts could have caused certain things here and there. But it was just fascinating. And, my friends were like, "Oh, wait, your dad has parts on this plane or this military jet?" And I'm like, "I think so." Yeah. It was kind of fun, and, I love flying. I love being up in the air. But in
Me too.
hindsight, I'm glad that I was able, and my parents had the foresight to allow me to kind of forge my own path.
That's what I was just about to say. You had to forge your own path. That's so admirable and so important. I mean, important values for your parents to teach you. And I'm sure, that just only helped you on your path. So like really valuing, your own hard work and the own efforts that you put in, for success. So go on. I'm sorry.
No, well, I mean, but again, I think, when and honestly, very lucky that I had the parents that I had. But it was just such an interesting kind of, with their business, it was starting to grow pretty well. His business partner, unfortunately ended up with an illness, so they decided to sell. And I'm not making this up. Their closing date was supposed to be September, I think, 18th of 2001. So planes hit the towers the week before. They're in aerospace. Everything shuts down. So, it was kind of one of these, like, he was riding a little high, and then everything got kind of more or less wiped out. And so, you saw him have to kind of go through the ups and downs and reinvent himself kind of, over the years. And, it's funny that, I've got two other brothers, and, we're all entrepreneurs in one state or another. And my dad had a funny comment about a year ago. He goes, "You've got three kids that are entrepreneurs, so it basically means one of them's always in the toilet at one point." So it's kind of like, it's kind of, but he understands it. And I think having that, I was very lucky to have that sounding board when, things were maybe challenging when we were starting, whether it was, portions of Pender going through COVID with Pender, with what we do in real estate debt. Obviously that was a challenging period for us, but I think really being able, again, being very lucky to kind of have that sounding board of somebody that's kind of been there and done that, and ultimately understands that, as long as you kind of keep your nose to the grindstone, keep grinding through, things will eventually break loose. And one of the biggest things that he instilled in me, and I learned this early in my career from some of my other positions, was number one, do what you say you're going to do, and bad news travels first. And that is the first thing you have to get out to people. Because ultimately, we're in a trust business, and it's a relationship business, no matter how much technology is kind of impacting things here and there. But if people really, if you do what you say you're going to do, and you tell them the bad news, early, you really build a lot of credibility. And for me, that's kind of one of our ethos here is, we want to stay around for a long period of time. We've been through obviously some ups and downs, when the markets have changed, and there's nothing you can really do about that. But as long as you say, do what you're going to do, don't drift from that, trying to chase, outsized yields, or, by putting in outsized risk. Ultimately, I think that's what people generally come back to us for.
I was going to ask what three qualities would you say are most important as far as being a CEO for Pender?
I think, again, I think honesty, resilience, and foresight. I mean, I think, each one of those you got to make the most informed decisions you have with the information you have in front of you. You've got to do what you say you're going to do. I mean, that to me has always been, if you're not doing what you're saying you're doing, ultimately it will come out and you will get burned at some point or another. And then just basically I've always said, we're a pretty open book over here. We're not in an industry that, ultimately what we do now, and we're in we're in the private credit space. We do a lot of senior secured loans across the domestic US. So it's ultimately it's an easy business to, kind of understand and conceptually think about, it is a very challenging business to execute because so much of it is relationship driven, both on the investor side and on the borrower sponsor side of who we're dealing with, why we're providing these loans. Because it's one of those things that if you burn a few people, you say you're going to do something and everything checks out and then you don't come through, you have lost that relationship that you have probably taken 5 years to cultivate. And you have to do what you say you're going to do.
It can take just a moment to destroy a relationship you've been building for years.
Just a moment. And really, Brittany, what we've really found, over the years in dealing with this, public companies or, down to the private companies is ultimately, when markets change on you, there's nothing you can really do about it. But what you can do is really educate your clients, because ultimately every investor that we have, we view as a partner, right? So the more that we can kind of explain to them what we're seeing kind of on our ground level, whether it's good or bad, hey, the bad conversations, they always start off if there's maybe a little bit of friction because everyone wants everything to do nothing but go up, but that's just not the reality of the way the world works. But when you educate them and explain to you, this is what we're seeing, this is what we anticipate happening. COVID was a prime example. I sent out a pretty pointed newsletter in one of our vehicles during COVID and said, hey, I think this is going to get really rough for the next quarter or two. This is what we're going to do to try to mitigate some of that. And we got calls right away from some of our largest investors that have investments in other companies similar to us. And they're like, well, Cory, no one else is telling us this. Do you really think it's going to be this bad? You sound a bit draconian at the moment. And I'm like, I hope I'm wrong. I really do. Because then things that obviously the world will be in a better place. But what it did is I think it really built more trust with groups, and said, hey, these guys are just going to tell us whether it's going to hurt them or not, of what they feel like we need to explain to our investors down the road. So, I don't think there's ultimately a secret sauce to anything. I think the resilience, the ability to just keep grinding. And, I just read this great book by Angela Duckworth called Grit.
I love that book. I've read it. And Angela, it's a great book.
Yeah. And Brittany, everything in that book, I mean, there's so many chapters I found myself literally highlighting, which I never really do with a book. And I kind of went back to it. And I'm like, there's so much truth to this. You just have to get up each day, whether it's going to, it's going to be a good one, or it's going to be a challenging one, and you have to get through it. And I think over time, and in any career path that anyone's really choosing, unless it's really, hey, this is just flat out not going to work, the more your ability to just kind of just grind through it, ultimately I think you're going to just generate more success. I saw that with my father early on. I was lucky enough to learn those lessons watching that as a little kid, and been able to take it to kind of what I do. My brother's kind of done the same thing, been through his ups and downs. And, that's kind of what we, ultimately do at Pender. Now, what we do is a little bit more boring and down the middle. So hopefully we shouldn't have these crazy ebbs and flows. But, at the end of the day, getting up and kind of getting in front of people and not telling them what they want to hear, telling them what, you think they need to hear about what you're doing. I think it ultimately builds a lot of trust.
Yeah. Well, yeah, our 2-week quarantine turned into 2 years real quick.
Yeah.
Real quick, and it's almost like we blinked and it just went by. It's crazy, I mean, and it changed so many lives. We live in a very different world now, it feels like, in so many ways. And I know a lot of people are still, recovering in a lot of ways from that, as well. How do you motivate your team at Pender?
Yeah, the motivation. I mean, luckily, it was really flashback to like pre-COVID. We really, we're really big on culture here. We really like when people enjoy coming to work, enjoy the people that they work with. We're a smaller offices, smaller teams. So pre-COVID, we did I think, a great job of, people just enjoyed being with each other. They enjoyed coming in. They enjoyed, kind of going out after work, every now and then. We would bring our Dallas team and our LA teams together for kind of some offsites to make sure the two offices had, a lot of, the coexistence was there. It wasn't a competition between the two offices. COVID took a lot of that out of the window, right? It kind of threw that office culture away. And, one of the biggest challenges, and I know we're not alone in this, is when you're trying to build back, company culture. Maybe you lost some key personnel, but now you're trying to bring them back in, and you're trying to get them to kind of work together as teams. And that has been a challenge in a post-COVID world. I think it's been a little easier for our Texas office, just because they didn't have to experience the same level of lockdowns as we did in Los Angeles.
California was.
Oh, it was funny. Like the office that we're in California, there's 16 consulates in the building. So the building kind of remained open, but I mean, for a good probably 16 months, I would sneak into the office and go up the elevator and just hide up here, but we didn't have team members. And obviously with the advancement in technology, you've been able to kind of, keep some of it. But when you're hiring somebody new in an environment like that, and they're trying to, hey, understand who people are via, a Zoom screen, it doesn't have the same effect as it did before, where, hey, we're sitting together. When we hire people, you could be the greatest person, but if you can't get along with your coworkers, especially in a smaller office environment, that could turn rather toxic quickly. So, I think it's just really, we want it to be a workplace that people have the ability to advance, collectively, as we say it all the time, as the company grows, the pie gets larger for everyone, right? Yeah. And, that's the people we want. We look for self-starters. We look for people that are hungry, that want to learn. We don't really, if you're a person that kind of wants to punch in, punch out, and, that's probably not the person that we want. We want people to take ownership. We want them to feel ownership. And, obviously managing styles are always a little bit different, but, we really like to empower our people that, hey, this is you, and I'm gonna allow you to make a mistake, and if we take heat for it, I'll take it. Don't worry about it. We don't want to mess it. We don't want to make the same mistake multiple times, but you have to allow your people to ultimately learn and to have the ability to make a mistake, and because that's the way they're going to grow. They're going to understand it. They're going to figure out what they need to do on the next iteration, whatever challenge that comes in front of them. And we've had a lot of changes with product types. We've had a lot of learning that we've had to do internally, and I feel very fortunate that we have the right personnel with us to allow us to move forward. And as we continue to grow, I mean, that's one of the big things too. I mean, I'll have people interview outside of their departments just to get different feels for who this person is, and if that person, who's not going to have to really interact, on a day-to-day basis, but is this somebody that you would feel like you want to come to work with, and work next to?
Yeah, I love that. So what sets you guys apart from other companies in this space?
Well, I think, number one, I think when you look back to kind of where our beginnings, so we had a Reg D product that we opened up in 2015. Really, more or less, it was we had probably 85% of our client base came from registered investment advisor channels. We have a couple, big 10 universities and some estimated, some global asset managers that came through us. One thing was really interesting, and I go back to this often. So back in, I think it was into Q2, early Q3 of 2019. We were just on a stretch that we could not win a deal to save our lives. We just lost it for about 45 days straight. I mean, every deal that we bid on, we just could not seem to get to the finish line. And it was one of those that we had to call back, several of our larger investors and said, hey, look, this is what we're seeing in the marketplace. And what we were really seeing was, when you're in the debt space, if you're more expensive than another, that's part of the business. You're going to lose deals because this cost differentiators. But when we were losing deals because, say, we were maxing out at the time, I'd say like a 70% loan to value kind of on a new purchase, we were losing because groups were going up to 85% loan to value. And, we called a couple of our investors and said, look, we feel like some of these other groups are really pushing the risk spectrum to secure the deals. And I've said it multiple times, it feels like people are taking equity type risk for debt type returns. And fundamentally, that did not make sense for what our investment thesis was, because we've always been principal preservation first, yield generation second. And it was really kind of telling, you flash forward, call it 9 months, you get into COVID, some of these groups that were really pushing the envelope there, they had serious exposure almost overnight. And not to mention that, certain groups in our space, you generate, different yields by, the amount of leverage we don't really utilize. We're generally around 10 to, 25% leverage on the fund, which is really more cash management than yield enhancement. But you were going up against firms that had 3x leverage. And so you couple that with, you're going up the risk spectrum, with your where you're in the capital stack, and then you're putting leverage on top of it. So it was kind of a perfect storm for certain groups to really get wiped out, or take some significant losses.
Yeah.
And something for us that we were very proud of. COVID was definitely challenging. Our returns went down for a period of time, but we never lost a dollar. We never had a down month. I think the worst we did was drop down to about 4.6% annualized returns. And we popped right back up. And I think that was just a testament to, really going back to do what you say you're going to do. This is our investment thesis. This is, it's, yield or principal preservation. That's, we kind of went up and down. And I think the best compliment I got during that period of time was, with what you guys had in front of you, and we absolutely had exposure. We had about 40% of our book that was in, retail, hospitality, healthcare, and office, which got, pretty much beat up. But somebody said that, you guys performed exactly as I would have hoped you would have performed in a time of this level of distress. And so that was kind of like, hey, we're doing what we're saying we're going to do. We don't have style drift here. And we've really been able to build such a nice origination platform. And, the vast majority of borrowers that we deal with, which generally are, equity funds or single family offices that have, real estate arms, most of them are repeat borrowers at this stage. And that's a testament. We're very firm with them, but we're very kind of, fair. Like, this is, if it fits these parameters and, we've got you checked out, unless there's something that's we're not seeing, this is probably a deal we're going to do. And they understand they're going to pay a little bit more for it, for us, for our capital, but they're willing to do so because, hey, we are a consistent source of capital for them, that they understand what the process is going to look like. And, not to say, like, our deal files still weigh like 13 pounds. They're huge, but we give it a very institutional level underwrite, but we do it in a more timely manner. And I think that's really bought us a lot of credibility on the deal side with the groups that we play with.
Yeah. I was going to ask, are there, the fact that you've taken Pender over to, $1 billion, in commercial real estate credit, like, what are there any other strategies that, key strategies you can share with our listeners for how you were able to, do that?
Well, most of what we do is a shorter term bridge, so 1 to 3 year kind of, loan. So, so we've originated, since we've started, over $1 billion for, again, we're able to recirculate or recycle some of that money kind of over, these days it's right around an 18-month mark. We'll have a loan that kind of we do, and then 18 months later, it pays back off. I think really, as you look at kind of where the world is at today, right? We've had, a massive interest rate kind of movement, from the Fed. We've had the regional bank dislocations, which is kind of, all the hallmarks of why private credit has, become such a talking point and such a focal point for so many investment portfolios. And I think with what we do, we play primarily in the lower middle market. So we're really targeting loans that are between, call it 10 and, maybe $35 million. Which even pre-COVID, that was always, and you had liquidity with the banks and whatnot. That was always a rather fragmented and inefficient segment of the marketplace. So we really were able to kind of capitalize on that. We used to send our deal teams to, local events in like in Oklahoma City or in the Carolinas, not the big nationals, the New Yorks, the LAs of the world, but really kind of, more of kind of fill in the gap America. And, what it did for us, it just created this tremendous amount of direct sponsor business that came directly to us. They understood what we did and what we do. And I think as you kind of, where we're at today is you just don't have that same level of competition from the regionals. We're loving it because, our loan to values now are 55% senior position. And, with what we're able to charge, because where the interest rate world currently is, it's just a phenomenal time to get the best risk-adjusted returns with the best sponsor quality, the best asset types that we've ever been able to see. So we're very excited for what we're able to do on a move forward basis for our clients, and really kind of where we fit in an investment bucket for a financial advisor for what they're dealing with on their clients. Hey, we've got a higher yielding instrument that's got some senior position security on this side. I used to say it was boring, hey, boring return profile, just nice and easy, steadying up. And until I found out boring was actually, not a bad word. It was actually something they liked. So I think it's really, I think the hardest thing these days is, commercial real estate is getting so many bad headlines, which rightfully so in some parts. But on our end, what we do is we're dealing with these groups that are going out and really negotiating pretty tough terms with sellers. And when that's coming in, we're able to set our risk exposure on new valuations and a lower price point, lower leverage point, for the sponsor. And ultimately that gets passed on to our investors. So it's kind of, it's really kind of a win-win on both sides. Our sponsors need this type of liquidity right now because it's very hard to come by. And for our investors, getting a very solid, return profile that doesn't have a ton of volatility, it's seemingly, kind of a match made in heaven at the moment.
Yeah. I was going to ask also, what types of challenges have you faced in the space of alternative type of, these real estate space?
I think obviously if you flash back to kind of COVID, I think one of the biggest challenges that we faced obviously was the elongated litigation timelines that you had in certain jurisdictions. Generally when you're a senior position lender, it's kind of, hey, you're the first to get paid, you're the last to take a loss, right? And it's really interesting. My partner Zach and I, we both dealt with so much distress, prior to Pender, that Zach used to joke, we've seen every reason a loan could go bad and why. And I will say, like, when you're in a normal time and the real estate valuations are kind of more or less static, if a borrower kind of trips up or falls down for whatever reason, generally we kind of liked it because you had 35% of equity protection in front of your first dollar of debt. So you could go through the legal process, maybe obtain the asset or even sell the asset, and generally you could probably make a little bit more on that, right? And one of the things that we've always done here is before we fund a loan, we've got our real estate teams, we got whatever, appraisals, broker priced opinions, but it really comes down to our investment team saying, do we feel comfortable owning this asset at this basis plus foreclosure cost? And ultimately, because you could have a great sponsor, but he's buying an asset in an area that's just, maybe if this guy goes away for whatever reason, this is going to be a challenging asset to manage. And I think that's, been one of those things that has really, additionally kind of, helped us work through like a challenging time such as COVID, and able to kind of push through and still generate those positive returns and not lose any money on any deal. That has been very beneficial. So I think those are areas that we kind of look at as we kind of move things forward of, hey, how do we get hurt? And how do we not? Now there's certain jurisdictions and, even though I'm sitting here in LA and, California used to have tremendous lender rights. Since COVID, it's been a bit more challenging. LA County, San Francisco County have been two very, very challenging jurisdictions or municipalities to get a foreclosure process through. So I'm sitting in LA, we've got one loan in California at the moment. So it's just really not a focal point for us. Some of the other states that you've seen, more of I think the population trends kind of move towards, they've been a little bit easier to deal with. So you're always looking at kind of, everything that, we're on the debt side, right? So we're looking at everything that could go wrong because we're not really looking at the massive upside on these assets. It's just, our job is to limit the downside. I think we've done a pretty good job of that over the years.
Yeah. Yeah. Well, where do you foresee things evolving in this space now?
Well, I mean, I honestly, Brittany, I think this is, what we've seen happen, since basically Silicon Valley Bank started that kind of, whole kind of domino effect of the regionals kind of pulling back. you've really looked at, and I was looking at some data from Green Street the other day, and they were showing kind of on one of their graphs, kind of where the regional bank world used to provide debt, and private credit was this big, and their projections in the future are kind of like somewhere like more here. So
Yeah.
although we believe the regionals are going to come back to a certain level, at some point over the next, year to 3 years, private credit is going to have more of a stranglehold in this than, in the private credit space, more generally speaking, but I'm really focused on the real estate side without a doubt, because you really look at the lower middle market, those regional banks were responsible for a very sizable portion of the takeout refinancing that was in that world. And they will come back to a certain degree, but I think, really this is going to be a heyday. I mean, it's going to be here. It's going to stay here longer. And, private credit, there's a reason that all the big shops are gearing up in private credit right now. And most of it's going towards the corporates. You're seeing more and more of it kind of come back into, hey, this is some real estate, but we strategically, we don't want to play against the big boys. We don't want to do the $100 million loans that there's more competition. We like this segment of the market that there's just more fragmentation, that we're able to kind of capture, what we think are the best risk-adjusted yields. And not to make it sound like a niche, but it's a very large volume space that there's just not as many, brand name players that play in it. And it's really kind of challenging when you're looking at if you're looking, I'm picking on Oklahoma City for some reason at the moment, but, if you're looking for a $25 million bridge loan in Oklahoma City, it's not very clearly defined of who you're going to go to. So having those relationships kind of keyed in some of those key markets really allows, a group like us to produce a lot of, loan origination volume. And I think one thing is rather unique to us, we don't buy secondary paper. We have an origination team. We know these borrowers from the moment they send us a loan all the way through the underwriting process, all the way through the asset management process. So for us, we kind of know where the skeletons are hidden, so to speak. So if somebody is not kind of, executing on their business plan or they're behind, we can call on them really quickly. So yeah, we're really excited. I think the next, 3-4 years are going to be an absolute kind of, heyday for groups like us. And I think it's more or less going to be here to stay. I mean, it was here, even though when there was liquidity back, you had to fight a little bit harder on certain deals to get things done. But for what we do, which is primarily value add commercial real estate bridge debt, there's a lot of good opportunities out there right now, and we're very excited about it.
What makes you so passionate about this space, real estate, and in this space,
Well, I mean, if you really look at it, Brittany, it's like you look at the financial markets, you look at kind of the turmoil. Obviously, the equity markets have been phenomenal for years. But this is really, we feel I think it's going to become more and more of a common part of an investor's investment portfolio. They're going to have something, alternatives have obviously kind of blown up over the last, 7-8 years. And, as we kind of get to where we're at today is, if you can generate a substantial, risk-adjusted return with a security instrument where you have a physical hard asset here that, if not everything goes wrong, you still have this asset that does have value. I think it's going to become a larger part of clients' portfolios, and I think we're very well positioned to take advantage of that.
I love it. So you mentioned grit earlier. What are some of your other favorite, books or resources for people who want to learn more?
Gosh, I mean, it's so funny. I'm in a complete autobiographies. That's kind of my thing these days. I'm reading on way too many planes, so I'm getting a little bit more reading time in, which is nice. I've actually just kind of gone back to books that were published for the last 20 years, and any avenue of the financial markets, because it's we're in a different world today, right? I mean, I think a lot of the drivers of where we sit today are drastically different than what they have historically been. But you look at the psychology of people and why they do certain things, and you're really looking for opportunities. And I think that we really have just landed in a funny opportunity. It's a space that we've always been passionate about providing this, because when you can work with a good quality sponsor on one side that's taking an asset that's maybe maybe dilapidated, maybe it's deferred maintenance, maybe it's been kind of a blight on a block of a community. What our sponsors can do when they can turn something around and turn that blight into, a part that maybe can revitalize a portion of a community. and we're able to kind of help with that and provide, our debt on the one side. That's to me where I think, why I get excited about some of this. So just again, going back to the books, I mean, I'm kind of all over the place. I don't really have any favorites. I mean, I think I've read the Grit book twice now. So that's been my one, just because, I think I've actually highlighted a bunch of passages and was showing to my 10-year-old. And he's looking at me like I'm nuts. But I'm like, this holds so much weight in anything you do in life, in any industry you go into.
Yeah. I just actually today just got The Soul of Wealth by Dr. Daniel Crosby. So I'm really excited to read that.
All right, I haven't read that one yet, but
yeah, really excited about that one. So yeah, definitely add that to your list, because he's all about, I mean, he's the expert in behavioral finance. So I just love him. I had him on here a couple months ago, but yeah, so you said you mentioned that you have a 10-year-old. I'm curious, what are you do you have just one child, or?
Yeah, I've got two boys, 10 and 8.
Yeah.
So my house is broken.
What are you teaching them? What are you passing along to them?
It's funny. My wife, so she grew up in Brazil, in Sao Paulo, but she, went to Stanford, Harvard Law, was a federal prosecutor. So she's much more the academic of our house.
Amazing.
Yeah, but I think between the two of us, it's just, and she's the same way. I mean, she goes, I just, maybe it wasn't, she finished, she did extraordinarily well, academically and in her professional life. But she was like, obviously very intelligent, but she goes, I don't think I was the smartest in every class, but I just worked harder. And I just kind of, was grinding that through. And, it's funny. I look at kind of teams. I did a lot of team sports when I was a kid, and, up through high school and college. And I see so many parallels to kind of the success you make for yourself kind of as you're growing up in some of those realms, to what you can do in your professional life as you get past all of that. And it really, at the end of the day, there is no substitute to the amount of hard work. And there was a great baseball coach, coach at Stanford. I heard him say to a group of kids, he goes, you talk about cross country runners, you see the people that are competing for, a medal at the end, there's no substitute to put it in the miles.
Yeah.
And I just, whatever reason, it kind of just stuck with me. I'm like, you're absolutely right. And it kind of just, in anything you do, I think in the world we live in today, that you see these success stories that everyone thinks there's an overnight success, that, you didn't see the last 10 years of just the sleepless nights of kind of working through challenges. And, I think, obviously with some of the all the unicorns in the tech world, people think that this is the norm, but you don't see the other tens of thousands of companies that didn't make it for whatever reason. And it just goes back to, like, if you trust the process, if you trust kind of who you are, your ability to kind of withstand. And again, there's no easy entrance to it. I mean, when I started my career, I remember that I was at that Weyerhaeuser Mortgage Corporation. I had a job that was this, but I would just kind of sit around all the management guys and, hey, do you need any help with this? Because I just wanted to kind of like learn and understand different avenues of the industry. And really what it did, it almost made me indispensable to a certain degree, because I could do everything. If somebody was sick, I could kind of go out and help out in that section. And I think it's just like a curiosity. I think once your curiosity kind of wanes, then you got to figure out something else to kind of, build it back up, and, constantly learning, constantly pushing through. And, that's the one thing that we promote, like, people here, like, hey, continue your education. It's in a perfect world, I never want to lose an employee, but I'm always proud of them. When somebody gets to the point, they come to me like, hey, I've got this opportunity here, and, hey, it'd be terrible to lose you, but, I love the fact that we were able to kind of be a stepping stone for you to somewhere else. And that's just, kind of, you gotta pay it back a little bit. I've had some tremendous mentors that I've been fortunate to have in my life, and I've got one of them. It's at one of the biggest, investment firms in the world. And I sit down with him quarterly, and he's like, you're not going to really get anything out of this. I'm like, you have no idea what I get out of these meetings. And so when I'm able to talk to, somebody that's starting, hey, this is what I did wrong. Don't do this, and help people back a little bit, because, ultimately, we need more, we need more small businesses. We need more different, investments, differentiators kind of out there, because the world's always evolving, and that's what's so fun about it. So
I love it. That is amazing advice. That's amazing advice. Well, where can our listeners find you and Pender Capital?
Yeah, Pender Capital, pendercapital.com. And then, if you've got financial advisors out there, that's generally who they can obtain literature, on what we do, generally through those advisors. Some of it is available on the website to a more retail type investor. And, we're always around. We're always happy to talk with anybody on the deal side. You can find you can find our origination team on the website as well. If you've got any questions there. And we're always happy to have a conversation. You never know where this crazy road of life takes you. But it has been really nice kind of dealing with the investors that we have. We generally we love, we talk to regularly. It's we like to know who comes in with us, because it just makes our lives a little easier. Especially and I always laugh, when times are good, everyone's good, right? It's just like I always laugh. It's like such a the flaw hider, right? For years, from 2000 and basically 12 to 2019, I mean, anyone could have entered the real estate space and look like a genius, right?
Yeah.
It's the times when things get really tough. That's when I think the more sophisticated groups that don't have the style drifts, that this is what we really do as a living. That's when we create so much extra value. And I think it's, now, you have the ability to withstand, downward pressures. So you've been there, you've done that. And I think that's where a lot of people have really liked kind of our story, of what they knew what, I did prior. They knew what Zach did prior with a lot of distress. But until we actually experienced a significant amount of distress through, our own vehicles, that's when people are like, oh, wait, these guys actually do know what they're doing. They can work through these items. And I think that just kind of builds more trust and, allows you to really push things kind of forward. And we're really excited about it. We're adding another person in kind of our distribution teams. We're working with, groups like Banrion. Yeah, we're very excited about kind of where this pushes us out in the future, and ultimately who we want to be. And as my one of my mentors of that, very large global asset manager, he goes, Cory, you don't have to be us. You can just be, a much smaller version, and you're going to be absolutely fine. And if you guys are providing this to your clients and you do what you say you're going to do, you're going to be around for a long time. You can really do something with it. And, I think he's absolutely right. And it's, for us, it's kind of just keeping the eye on the prize and, going back to grit, just waking up every day, just getting back in front of it.
Grit. I love it. I love it. Well, thank you so much, Cory, and for taking the time to chat with us today. I learned so much, and I hope our listeners did too. Thank you, everyone who has tuned into this episode, and very excited for the next one. Be sure to follow us on all of our social media. Banrion Capital is on Instagram, X, Twitter, whatever we're calling it these days, LinkedIn, and all of it. So give us a follow, and I will see you next time right here from the Green Couch. Everyone have a great day. Thank you.
Thank you.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investment involves risk and possible loss of capital. Please seek advice from a licensed professional.